Okay, so welcome back and let's have a discussion on the 4 questions that are left for the bond refunding. In fact, there are 5 questions. The last question is dirty price, clean price of the bond. We'll take it later on. For the bond refunding topic, there are 4 questions, okay? And I will take just one. Why? Because all the other 3 questions are either easy or similar in nature. So I will take the difficult one. 104 or 106. Anyone. Okay. So the first and let's say second and third. All the 3 questions I'm giving you as homework. The 6th one will be taken by me as it is a difficult one. If you understand the 6th one, I think rest of the questions are 99% same or easier than that. So maximum information will be there in 106 only. Okay, let's come to the bond refunding concept. The concept is very easy. That's why it won't take much of the time. Okay. Now, the entire story will start like this. Let's say, for example, you issue the bond at this point. Okay. And the moment you have issued the bond, let's say, for example, the 10% was the coupon rate. Okay. So what is happening on face value, let's say 1000, you are paying some interest every year, which is 100 rupees. Agree with that? Which is 100 rupees. You have set the coupon rate in such a manner that the people should buy the bond in the market. So if the market is offering on and around 10% of the interest rate, you will have to do the same thing. So you issued the bond in the market. Okay. Practically speaking, now we are talking from the angle of the company who has issued the bond, not the investor who has invested in the bond. We are not talking from the angle of the investor. Think from the angle of the company who has collected the funds from the investor. So this 10% is practically speaking a cost every year, or we can say cash outflow every year to the company. Okay. Now what is happening? Let's say the time for the bond was 10 years. And let's say at the end of 4 years has gone, you have paid 100 and 100 rupees. At the end of the 4 year, market conditions changed and the current coupon rate going on in the market for rest of the bond is on and around 6%. What will happen? Now today what you can do is you can continue the bond. You can continue the bond that you had issued 4 years back. What will happen when other people are using the investor's money and paying only 6%, that is 60 rupees of the interest, you will be paying 100 rupees as the interest. So you will be paying practically speaking 4% extra because that was the condition at which you had issued the bond. So that's why you will have to pay it. Now in order to protect the company, or in order to hedge the company, hedging means protecting from the risk or reducing the losses. In order to reduce the loss or cut down the cost, what the company does, where at the time of issuing the bond, they make it a callable bond. What happens with this feature is that if the company wants at any time in this before expiry, company can call back the old bonds. That is called as callable bonds. And that means refunding the bond. Once the company calls the old bonds, investor will have no other option but to give it back to the company and take the redemption value. That is called as redeeming the bond before maturity or refunding the bond. So you are giving the investors their money back. And let's say for example the total issue was 100 crore. The total issue that you are making today is of 100 crore rupees. Now, if you have to refund all the investors with these bonds, with this 10% bond, you will have to arrange 100 crore rupees in the market. And suppose you don't have that much of the money, from where you think you can pay to these people? You will have to issue new bond. The fact is, you don't want to pay 4% extra. So what you should do right now is issue new bonds in the market at 6% coupon rate, face value 100. You can do it like this, face value 1000, and balance maturity, which is 6 years. Okay, now you issue this new bond in the market. What will happen? The moment you issue this new bond, you will collect 100 crore from this, and you repay that, you pay that 100 crore to these guys, and these bond holders will be out of the picture from this point. Because it was callable bond, you had the right to refund the bond to these people. But the moment you refund the bond, what happens is, because you are refunding the bond before maturity, you pay some call price. That means an extra money over 100 crore. That is your expense. So let's say, for example, you add around 5 crore rupees and you will repay 105 crore rupees. So what will happen? 5 crore will be debited as an expense. 5 crore will be debited as an expense for refunding the old bond. Since you are debiting the 5 crore rupees, there will be some tax saving on this expense. We will talk about it later on. Okay. Now what happens is, whenever you issue the bond, this bond or this bond, you have to bear some issue cost, or we can say initial expenses. We will call it as issue cost. Now let's say the moment you issued these bonds, the issue cost was 10 crore rupees. Just an example. Let's say the issue cost was 10 crore rupees. However, it is very big compared to the 100 crore rupees of the issue. So let's reduce it to 1 crore only. Now what happens is, the purpose for which you issued the bond was to expand the business by using this capital, and these bonds were issued for the rest of the 10 years. That means this bond will be over, or the bond will be redeemed after 10 years. That means you are using this 100 crore rupees of the money for 10 years. That's why what is going to happen, the issue cost that you had to bear in the beginning, 1 crore rupees, will also be debited to profit and loss account proportionately over a period of 10 years. So every year 10 lakh rupees by 10, every year 0.10 crore, you can say, every year 0.10 crore will be debited to the profit and loss account, and balance will be called as unamortized portion. Issue cost of 1 crore rupees will be treated in two ways every year. There will be some amount which will be amortized, means expensed out in P&L account, and the balance will be left in the unamortized portion, unamortized balance. So in 4 years, how much of the 1 crore rupees has been transferred to profit and loss account? 40 lakhs. And the balance which is left in unamortized account, or we can say unamortized issue cost, is 60 lakh rupees. Okay. Now tell me one thing. In the beginning you had such kind of scenario, but after 4 years you are pretty much sure that you are not going to continue with the old bond. Now what we are going to do, since there are two types of bond, we will call this as old bond and we will call this as new bond. This one as new bond, this one as old bond. Now after 4 years, since we are we can say with guarantee that we are not going to continue the old bond, what will happen to this unamortized balance of the old bond? It will also get transferred to profit and loss account. However, the cash outflow was already happened at the beginning when you issued the bonds. 1 crore was paid totally in the beginning itself. Now the only thing happening every year is it is being transferred to profit and loss account, and the tax saving portion is being utilized. So the only benefit of transferring this unamortized portion of cost is tax saving. Every year when you are transferring some amount to the profit and loss account, you are just reducing the tax portion. So on 60 lakhs, there will be some tax saving because you are transferring the entire bond. Why you are transferring the entire 60 lakhs to profit and loss account at this point? Because if you are not continuing the old bond, there should not be any cost related to the old bond which will be continued. So old bonds related unamortized cost, any cost, it may be issue cost or it may be discount, any cost should be transferred to profit and loss account. But remember one thing, when you transfer this to profit and loss account, that doesn't mean it is a cash outflow. Cash outflow already happened when you paid 1 crore rupees in the beginning. The only benefit of transferring this to the bank profit and loss account is the tax saving. Now what will happen? The issue cost was incurred at the time of issue of old bond, and it will also be incurred at the time of issue of new bond. Now let's say for example, at the time of issue of new bond, the issue cost happens to be 1.2 crore. Now what will happen? Do you expect this to be the cash outflow at this moment? Yes. The entire cash outflow will be at the end of 4th year, but it will not be expensed out. This is our expense, but not to be treated the entirely in the first year. This is the issue cost for these bonds, and these bonds are going to continue for the next 6 years. That means the issue cost should also be apportioned over a period of 6 years. So every year 20 lakhs rupees of the issue cost will be transferred to the bank account, profit and loss account. And then it's we can say that tax saving will be calculated. So tax saving at 0 point of time is nothing for the new issue cost, but for the old issue cost there is a tax saving for unamortized portion today itself. Okay, that's great. What else is left? Right now, whatever I'm saying, why I'm saying all these things are, the thing is very simple. Company doesn't want to pay a lot of interest when the market rate is going low. Company will refund the old bonds and start with the new bond so that they can save up on the tax interest payment of 4%. But this is not the only thing which is being saved. There can be some outflows and expenses, and ultimately you may end up having losses if you refund the bond. So what you have to decide in the entire question is, should you refund the old bonds or not? The only thing that we should do is, from this point onwards, divide all the time and entire time into 3 parts. This is called as initial cash outlay, cash flow. This is called as intermediate cash outflow, or we can say operational cash outflow, cash flow, not cash outflow, cash flow. And this is called as terminal cash flow. Okay. First thing that you should do with old bond and the new bond is divide the entire time into 3 parts, and then take a part at a time and find out all the cash flows that are happening at initial stage, 0 stage. Then find out all the cash flows that are happening every year till the end, and then find out the terminal cash flows that is happening at the end. Then calculate the present value of all these 3, and then do the total. That will be the present value of future cash flows of old bond, and then do the same with the new bonds. If you would have continued old bond, that would be the present value. If you would have continued with the new bond, that would be the present value. Whichever's present value is beneficial for the company, go with that option. If the new bonds outflow is less, we will go with the new bond. If the old bonds outflow is less, we will go with the old bond. All in all, you have to calculate net present value, and then you have to decide whether you should refund the old bonds or not. So the entire story of bond refunding starts from the need of reducing the cost in the market. For that purpose, you will issue the new bonds to refund the old bonds, and then you will start calculating the cash flows at three different points. Then calculating the present value of all these three, and then totaling it to decide whether you should go with the new bond or old bond. So this is what we are going to learn from a question. Have a look. Question number 106. Messrs Trans India Limited is contemplating calling. Calling means these are the callable bond, and that's why you are calling back those bonds. 3 crore of 30 years 1000 rupee face value bond issued 5 years ago. Have a look. Every time in bond refunding questions, what you should do is this. Where did I write bond refunding? Let me just check. Did I just write it in? Okay. Old bonds. Every time you should be clear with the data given. So create a table format. Okay. Coupon rate, face value, time left till maturity. What else will be there? Let's just check out. Okay. So 3 crore of 30 years 1000 rupee issued 5 years back. See, original maturity was 30 years, but it was issued 5 years back. So the past doesn't matter to us. What is left with this bond is the 25 years to maturity. Now have a look. Face value is 1000. Time to maturity 25. 3 crore can be written in lakhs as total value 300 lakhs. I will just do all the calculations in lakhs. And if you divide the 300 lakh with face value, you will get the number of bond that has been issued. That's 30,000.30 lakhs bonds has been issued in the market. Okay. But another thing, 5 years ago with a coupon interest of 14%. So 14% is the coupon interest. That means the coupon amount is 140 rupees. Okay. Next thing. The bonds have a call price of 1140. That means you are paying the call premium. We can say call premium of 1140 minus 1000. 140 rupees extra you are paying on every bond just because you are calling them before maturity in just 5 years. So I will just calculate this. Understand? 1140 minus 1000, 140 into 0.30 lakhs bond. So 140 into 0.30 goes to 42 lakh rupees I am going to pay as a call premium, which will be my cost today itself, and it will entirely be expensed out in the profit and loss account, because from this point onwards, fifth year onwards, I'm not continuing with the old bond. So any cost related to the old bond should also not be continued. So entirely it will be a cash outflow at 0 time and expense at 0 time. Okay, the next thing, please read. Okay, the bonds have a call price of 1140 and had initially collected proceeds of 2.91 crore due to a discount of 30 rupees per bond. So you had also given discount in this bond. That was nothing but 30 rupees on every bond. So that's 9 lakh rupees. 9 lakh rupees of the total discount given for this bond. You didn't collect 1000 rupees in the beginning. You issued the bond at 30 rupees discount, 970 rupees. And that entire 9 lakh rupees went to the discount account. And these bonds were issued for 30 years. that means the discount will also be amortized. Any cost related to this bond was we started this discount amount to amortize every year in the profit and loss account. How much? 9 lakh divided by 30 years at the time it was issued. So 0.30 every year we are transferring to the P&L account. We can calculate how much of the total discount we have already transferred to the profit and loss account and how much is still balance in the discount unamortized portion. So let's calculate it this way. A simple way to calculate is unamortized discount. See, the calculation will be like this. 30 into 0.30, that means 9 lakh is the total discount. When you divide it by 30, it becomes 1 year discount and still 25 years are left. That means this much of the discount is still left in the discount unamortized portions, unamortized discount account, 7.5 lakhs. Okay, next thing. From this point, the initial floating cost was 3,60,000 rupees. Now we are going to calculate excuse me, unamortized floating cost, or we can say issue expenses. Why we are not taking entire cost and just the unamortized portion? Because 5 years has already gone and some of the discount and floating cost was already debited to profit and loss account, and that is of no use today. Which figure will be used today is the unamortized portion, which is still to be transferred to profit and loss account. So unamortized portion of the floating cost, the issue cost at the beginning. The issue cost was 3,60,000 rupees, right? Now we can do it like this. 3.60 in lakhs divided by 30 will give you 1 year's 1 year's floating cost, multiplied by 25 will give you how much is the floating, how much of the floating cost is still balance in the unamortized account. That's 3 lakh. Now understand, there is one account in the balance sheet on the debit side which says that unamortized discount account and unamortized floating cost. Every year 30,000 is being transferred from discount account and how much? 12,000 is being transferred from this floating account to the P&L account. Now this much is the balance at the time when we are deciding to call the bond. See, all these cost, discount and floating, these are the cash outflow. These were the cash outflow when the bond was issued. Okay, and these will be transferred entirely to the profit and loss account if we are closing this bond. If we are closing these bonds, these costs should also be closed out immediately. So there are 3 types of cost related to the old bond that you should understand. 0th point, 5th year and 30th year. Okay, discount was given on this date, so cash outflow, we can say the money that we didn't collect is said to be the cash outflow, and issue cost, and one more cost will be here, that is called as call premium. And now we are standing at this point. Now tell me, the cash outflow under discount was already happened at the 0th time. Issue cost was already paid at that time, but both of these were not transferred to profit and loss account, were not treated as an expense on that year. Instead, that expense is amortized or apportioned over a period of 30 years. Okay, so the expense on this discount will be taken today. The expense on this issue cost will be taken today. And for call premium, we will consider cash outflow today, and we will consider expense also today. So understand, in the profit and loss account today, when you close the old bond, in the profit and loss account, you will see the unamortized portion of the discount, unamortized portion of the issue cost, and the entire call premium. And in the cash flow, you will just see the call premium. These were the cash flow outflow that has already been happened. So we are not going to repeat it. The only thing that will happen is this. Discount will be treated as unamortized portion of the discount will be treated as expense. Issue cost unamortized portion will be treated as an expense, and call premium will be treated as cash outflow and expense both at this date. Okay, this was all related to the old bond. Now have a look. The company intends to sell 3 crore of 12% coupon rate 25-year bond to raise funds for retiring the old bond. Obviously, these old bonds, when we are going to pay to the old bond holders, we will have to arrange new money, right? So at that time, we are issuing the new bond at 12%. Face value will be 1000. Time will be 25. The amount will be 300 lakhs. Okay. The total number will be same as 30.30 lakhs. And there is no call premium in this case. We can say not applicable for the new bond. Call premium is applicable only in case you are recalling the bond. You are closing the bonds. The new bonds have been issued. There can be some discount and there can be some floating cost in the new bonds as well. Let's see whether it is given in the question or not. Okay, we'll start from this. It proposes to sell the new bonds at their par value. That means no discount, no premium. So nothing. Discount is nothing. Also, the estimated flotation cost is 4 lakh rupees. So there is some kind of estimated flotation cost, which is 4 lakh rupees. Got it? This 4 lakh rupees will not be debited to the profit and loss account today. This 4 lakh rupees is incurred for the purpose of issuing new bonds, which will go on for 25 years. So this 4 lakh rupees should also be distributed to the profit and loss account equally in the next 25 years. Okay. Now, the company is paying 40% tax and its after tax cost of debt is 8%. Underline this. This will be treated for the purpose of calculation of present value factor. If you are discounting the bond, the discount rate should be the cost of debt, after tax cost of debt. Understand this. Generally, cost of equity is said to be after tax, but cost of debt is always before tax. But for the calculation of present value factor, we always need KD1 minus T. That means after tax cost of debt. Understand the difference. Cost of equity means the dividend which is paid from the after tax profit. That's why cost of equity is also called as after tax rate. But cost of debt is interest amount which is paid from the before tax profit, and that's why KD is always treated as before tax rate. But for calculation of present value factor, we need after tax. So KD is the only factor which we have to transfer it into after tax rate by multiplying it with 1 minus T. Okay, so after tax cost of debt is already given to us, which is 8%. As the new bond must be sold, as the new bond must first be sold and then proceeds, and their proceeds then be used to retire old bond. The sentence framing is not proper, but I will tell you one thing. What is happening is that since you have to pay, see, as the new bond must first be sold, before refunding to the others, you will have to collect money from the new bonds. So first you will issue new bond, collect the money, and then pay it to the old bondholders. And this entire process cannot just happen in a single day. It takes a lot of time. So we are assuming that from the moment we will collect the money from new bonds and paying back to the old bonds, 2 months of overlapping time will happen. In that 2 months of time, our balance sheet will show the new bonds and the old bonds, both of them. And what will happen because of that is you will have to pay the interest on both the bonds. Okay. So basically speaking, for 2 months, you are going to pay extra interest to the old bond holders at 14%. That is what you have to cover. Now, if you go with the old bonds, there will be one more expense. If you refund them, there will be one more expense added in the old bonds, which is overlapping interest, which will be called as overlapping interest. I will just show you what will be that. Just imagine a point. At this point, new bond will be issued. We will get 300 lakhs in our bank account, but it will take some time to refund the old bond holders. Let's say the final refund of the old bond holders happened here after 2 months of this point. Now you can clearly see the old bonds were being used for the period of 2 months. Don't you think the investor or the bond holders will also demand interest for this 2 months? Yes, they will demand the interest for this 2 months as well, and that should also be considered as an expense and outflow on this date itself. So what is going to happen? Calculate 14% of the interest. You are paying extra interest because you are carrying old bonds to 2 months more, for 2 more months, right? See, 3.30 are the numbers, 0.30 lakhs. Then, or I can clearly write it like this: face value is 300 lakhs into 14% into 2 by 12. Am I right? 2 by 12 means 14% is the coupon amount for the entire year. What will be the coupon amount for 2 months? 300 into 14% divided by 12 into 2. So it will be 7 lakh rupees. This is the extra interest that you will have to bear. We will call it as overlapping interest. Now understand one more time. This is the point where new bond will be issued and we will get 300 lakh rupees in our bank account, and it will take some time to repay to all the bond holders, and we are assuming that it will take around 2 months to repay the old bond holders, and that's why for the 2 months the balance sheet will still show that we are using the old bond holders money, and that's why we will have to pay the interest for 2 more months on the old bonds. Okay, and that is what is there. So we'll pay this much, and still we are going to use it as an expense. We will be saving some tax on that. Tax savings at the initial point itself. Okay, that's great. What's more is given in the question. As the new bonds must first be sold and their proceeds then used to retire the old bonds, the company expects a 2 months period of overlapping interest, during which interest must be paid on both old and new bonds. Okay, what is the feasibility of refunding the bond? That's it. Everything is being cleared now. These are the cash flows you can clearly see in front of you. Now you have to decide what is the feasibility. You imagine if you are continuing the old bond, what will be the cash flows? If you are continuing the new bond, what will be the cash flows? And whose present value of cash inflow is higher or outflow is lower? That option should be preferred, simply. Or you can mix both of them and do it in just a single calculation. Have a look now. What we are going to do for all the bonds, old and new, we are going to divide all the cash flows in 3 different parts. Initial cash flow, operational cash flow. This is going to be first initial cash flow, operational cash flow, and terminal cash flow. Okay, I will tell you what are the initial cash flows. Initial cash flows. Issue new bond. If you will issue new bond, you will get 300 lakh rupees. Am I right? For that 300 lakh rupees, you will have to bear some issue cost. New bonds. You will have to pay some issue cost. That is your cash outflow. 300 minus the issue cost will be 4 lakhs. Getting it? Floating cost. That will be 4 lakhs. You will pay that much of the amount. Then You will repay to the old bondholders, that will be 300 lakhs. You will pay them the call premium also, that will be, premium means the extra amount for repaying the old bonds, 42 lakhs. Okay. Then you will also be paying overlapping interest. How much? 7 lakhs. Since that is an expense at this time, we will also take the tax saving on this. Tax saving on this will be debited to profit and loss account, and this will reduce our taxes by how much percentage? 30%. The tax rate is 40%, sorry. So 40% will be the saving on this. Do you remember the NPV calculations that we used to do in CA Inter? 7 into 0.40. So we will save up on some amount, call premium outflow, this is outflow, interest is outflow, tax saving is inflow, so 2.8. Okay. What else? Call premium. See, this is the call premium. This is also the cost, expense. We should also consider tax saving on that. So I will just take this part here. It will be better. So tax saving on call premium, 42 into 0.40, 16.8 will be inflow. So call premium, tax saving on that. Overlapping interest, tax saving on that. These are the outflows, that's why these are also taken. Another thing, what will happen? These two, unamortized discount and unamortized flotation cost, will get transferred entirely to the profit and loss account. So, do you think these are the cash outflows? No, sir. The cash outflows already happened. See, in this case, when I told you, call premium is something for which the cash outflow is happening at this point and the expense is also happening at this point. So, we'll save the tax. We'll go with the tax saving also. But discount and issue cost are only relevant for the purpose of tax saving today. So if you debit entire amount to the profit and loss account, only thing that has to be considered is the tax saving, because the outflow has already happened. So what is the amount? 7.5 and 3. Understand? Tax saving, what I am going to write? Tax savings on discount and issue cost. How much is the discount? 7.5 and 3. That is 10.5 into 40%, am I right? 4.2. What else do you think will happen at 0 point of time? At 0 point of time, you will get 300 of the new bonds, 4 you will have to pay as an issue cost, repayment of 300 lakhs to the old bond, call premium repayment, payment, tax saving on the call premium, overlapping interest for 2 months, tax saving on the interest, overlapping interest, then tax saving on the discount and issue cost written off in the balance sheet. This was the balance in the debit account, balance sheet, asset side. Now these two are written off. That means transfer to the profit and loss account, because related bond has also been closed. So these will also close. So we are taking tax saving 7.5 plus 3, 10.5 into 40% is 4.2. All these will be the cash flows that will happen at 0 point of time. Let's do the total of these. 300 minus 4 minus 300 minus 42 plus 16.8 minus 7 plus 2.8 plus 4.2. So somewhere around 29.2 lakhs will be your cash outflow just in the beginning. Understand? This is the mix of new and old bond. The issue income from the cash inflow from the new bond, outflow from the old bond. This is going to be 29.2. Obviously, you are going to do it properly in a table format. Just write down particulars and then amount. New bonds, cash received from new bonds, cash paid to issue cost, repayment of old bond, tax saving on the call premium and call premium. Write down everything line by line and then the cash flows. Now comes the second part. This is going to be working note 1. Now this is going to be working note 2. We will call it as the present value of operational cash flows. First of all, understand the difference now. You were paying interest on the old bond. How much? 300 into 14%. 42 lakhs. This is saved. You don't have to pay it now. So the amount that we have saved from cash outflow will be considered as cash inflow. Also, interest on new bonds will be 300 into 12%, that is 36 lakhs. So practically this is going to be the outflow now. 42 lakhs saved and 36 lakh paid. So practically speaking, we have saved in interest cost, savings in interest, which is 6 lakhs. Do you agree with this? Do you agree with this? There will be one more thing. Earlier you were debiting 42 lakhs every year in the profit and loss account when you were continuing the old bonds. So if I assume that I am continuing the old bond, 42 lakhs will be debited to the profit and loss account, and accordingly the tax saving will also be taken. So earlier the tax saving was 42 into 40%. Now the tax saving is for 36 into 40%. 16.8. Understand? 16.8. And this is going to be 14.4. Now these are the cash inflows to us. These were the cash outflows. Since the savings is there will be cash outflow in here. Earlier we used to save 16.8 lakhs in taxes. Now we are saving only 14.40 in taxes. That means we are incurring a little higher amount of tax, or we will have to pay a little high amount of tax, which will be considered as an outflow. How much? 2.4. which is nothing but the 40% of the interest saved. So if this is an inflow, tax saving will be considered as outflow because there is a less tax saving now. Earlier there was a higher tax saving, now there is a less tax saving. The inflow has reduced, that will be considered as outflow. So this 2.4 will be tax payable on savings in interest. Tax payable on savings in interest, which I am going to write down. Okay, let it be there. Tax payable on savings in interest 2.4. It becomes outflow. Understand? Okay, this is all about interest. What is going to happen every year? Every year you will be paying interest. Every year you will be saving taxes. Both of them has been considered. Now, apart from interest, there was one more thing that used to happen every year. Interest was cash outflow. Tax on interest was cash inflow. And again, tax on discount and flotation cost was also cash inflow. Every year these were the three cash flows that used to happen. Now what is going to happen? We will be saving some interest and we will be paying some taxes on the saved interest. In the similar way, we will have to take what was the expense for discount and flotation cost every year and what is the discount and flotation cost now in the new bonds every year. That will bring you to a new amount which will be called as the reduction in the expense. If the expense gets reduced, tax becomes payable. See, tax on, not a tax saving, tax on discount and unamortized expense or flotation cost. Understand? Old bond, new bond. Discount, flotation cost, and flotation cost. In the old bond, every year we used to debit the discount of around how much? 30,000? 30,000. Every year we used to debit the discount of 30,000 to profit and loss account. That was not the cash outflow, that was just used for the purpose of tax saving. And in flotation cost also, every year it was 12,000 rupees. How much? 3.6 divided by 30. Every year 12,000 rupees was being debited. In the old bonds, the total expense that we used to consider was 42,000. Okay. But now the only expense that will be considered every year is the flotation cost of new bond. What is the flotation cost of new bond? It comes to 4 lakhs divided by 25 years. Am I right? That's 16,000 rupees. Every year you will only be debiting 16,000 rupees to profit and loss account. Don't you think this will reduce your expenses? Yes, sir. The reduction in the expense will happen to the extent of 26,000. This is neither a cash outflow nor cash inflow. This is neither cash outflow nor expense nor cash inflow. This is called as reduction in expense. What do you think what will happen when you reduce the expenses? Tax becomes payable at 40% of this. That's 0.104 will be considered as outflow. The only cash flow is this 0.104. The only cash flow. Understand the difference between two. If you continue with the old bond, you will be debiting this much of the expense in the profit and loss account. So you will be taking tax saving on this 42,000. But since you are not continuing with this old bond, there will not be this much of the expense. This much of the expense will no more be debited in the profit and loss account. But instead of that, this much of the expenses will be debited in the profit and loss account for the new bond. So that brings us to a new thing which is called as reduction in expenses in every year. When we refund the bond and bring the new one, there will be a reduction in expense. The expense when gets reduced, tax becomes payable. So what will happen at this place? Tax on discount and flotation cost will be calculated as this. 42,000, that means 0.30 plus 0.12, that is 42,000 minus 0.16 new payable into 40%. The tax, that will be 0.104 outflow. This will take some time to understand, but it is easy. What used to be the cash flows there. Now, these are the only cash flows. 6 lakh rupees of the interest is being saved every year. Because of that, 2.4 lakh tax becomes extra payable. And because the lesser amount of expense is being debited in the profit and loss account of the discount and flotation cost, the tax again becomes payable. And the total saving every year the total saving will be 6 minus 2.4 minus 0.104, that's 3.496. This is the savings every year. And now calculate, this is going to happen every year for the next 25 years. We have to calculate the annuity factor at 8%. Because this is going to be the cash inflow, 3.496 cash inflow for 25 years. So what we are going to do, we are going to multiply this with the annuity. This is nothing but our annuity. And we will multiply it with the present value of annuity factor, which is not given in the question. We can calculate it on the calculator. 1.08. 1 divided by 1.08. comes to 10.675. For the next 25 years, every year, because of the new bond, we are experiencing a cash inflow of 3.496. How? Because there is a less outflow of interest, higher tax payable and higher tax payable in this case. So every year 3.496, and the present value of that will become 10.675, 37.32 lakhs. First figure, at 0 point of time you are experiencing this outflow. At 1 to 25 years, for the next 25 years, the present value of those cash inflows is 32.37 positive. Now the last thing, terminal cash flows. What will happen in both the bonds at the time of maturity? If we continue with the old bonds, we will pay them 300 lakhs back as a redemption. If we continue with the new bond, we will also pay them 300 rupees back as a redemption. So practically there is no extra cash flow on terminal or on maturity. So the terminal cash flow will be zero. Terminal cash flow will be zero. We divided the entire scenario of old and new bonds in three different parts. The cash flows happening at 0th point, cash flows happening every year multiplied by annuity, so that we can take the present value of all those things, and cash flows happening at the terminal. So we found that there are no extra cash flows at the terminal in old and new bond. The cash flows are same. So incremental cash flow is zero at this point. Incremental cash flow, terminal cash flow is zero. So these are the three things available. First, 0 point of time, 1 to 25 years and 25th year. Now we can easily calculate the NPV of refunding the bond. It will be present value of cash inflow, or we can say initial cash flow, operational cash flow and terminal cash flow. Initial cash flow was 29.2 negative, means outflow. Operational cash flow 32.37 and then 0. 3.17 is the NPV. What is happening now? NPV of refunding option is coming to positive. That means if we refund the bond in this scenario and bear all these costs, still we will be left with a positive cash inflow in the beginning. So it's better to refund the bond because NPV is positive. This is the end of the story. I know it took almost 1 hour to discuss the question, but this is what happens in the bond refunding. Let's look at this question now. What has been done? I think there is some mistake. Mistake in this calculation only. We'll just correct it and write it here. 3.496 into 10.675 goes to 37.2, right? 37.32, and if I write that 37.32, the answer will be 8.12. So 8,12,000 rupees, you can say 8,12,000 rupees is the NPV which the bond refunding is recommended because NPV is positive. We can clearly see. Now have a look on this part. What happened in the working note? Practically speaking, I'm again taking the answer, so it will brush up your concept. This is the initial investment. This is annual cash flow saving. The third part is not taken as a terminal cash flow because it has no relevance. At the end of the 25th year, both the bonds are having same cash flow, so there is no incremental cash flows. Now what is being followed? We are following incremental cash flow approach. Understand this. Incremental cash flow approach. Okay, so initial investment, we are paying the call premium to the old bondholders how much? 42 lakhs, but we are also saving the tax, that is 16.80 lakhs. So the net cash outflow will be this 25 lakhs 20,000. Then the flotation cost on the new bonds have been incurred, so that will also be a cash outflow. But understand, there will not be any tax saving in the beginning. This flotation cost is being incurred for the next 25 years. So the tax saving on this will be taken in the second working, which is annual cash flows. Okay, overlapping interest, this is related to old bond, this is related to new bond, this is related to old bond. Whenever you see a cash flow relating expense relating to old bond, the tax saving will happen immediately. Overlapping interest, for the 2 months you are paying 14% on 3 crore rupees. So that becomes 7 lakh, less tax saving because it is an expense, we will save some tax, and the after tax cost will be 4,20,000 cash outflow. Okay, this is a better way of presentation. Okay, good. Tax saving on unamortized discount on old bond. Understand this. This is related to old and this is related to old bond. See, unamortized discount. How much is the unamortized discount? The total discount was 9 lakh rupees, but unamortized portion was 25 by 30 years. So what you are doing is you are dividing 9 lakh rupees by 30 years to arrive at annual discount, and then multiplying it 25 to find out how much is the unamortized portion. So 9 lakh minus 25 by 30 will give you unamortized discount lying in the asset account. And when it is multiplied by 40%, that will give you the tax saving on unamortized discount, which is written off in the balance sheet. Profit and loss account, written off. Why it is written off? Because we are closing the old bond, so we have to close all the pending expenses. Okay, the same thing happened with the flotation cost also. 25 by 10. Why 10? Why 10? It should be 30 now. Just let me have a look on that. 3,60,000 divided by 30 into 25 into 0.40. Yes, please do some correction here. That is a printing mistake. It should be 30. I will also do it in the next edition. It should be 30. The calculations are right, so don't worry about the calculation. And this becomes 29,20,000 as an outflow. Do you agree with this? This is what we saw. All these are the cash outflows at 0 point of time. And then we move a step forward and calculate annual cash flows. Old bonds. The cash flows related to old bond if it is continued. If we would have continued old bond, then we would have paid 42 lakh rupees every year, 3 crore into 14%. That would have been an expense, and we would have saved 16 lakh 80,000 as a tax saving. So the net outflow is 25 lakh 20,000. Apart from that, if we would have continued old bond, there would be some amortization of discount and flotation cost every year. How much? 9 lakh divided by 30 means 30,000 rupees every year we would have transferred to expense P&L account of discount, and 12,000 from flotation cost every year would have transferred. But these are not the cash outflows, so that should not be taken. The only benefit of transferring this to profit and loss account is the tax saving. So that's why multiplied by 0.40. So these are the two tax savings that we need to consider. Okay, if we continue with the old bond, every year this will be the cash flow, cash outflow in fact. Okay, it is after tax payment. This is an outflow. But are we continuing with the old bond? No, sir. That means this entire thing will become a saving for us. If we continue with it, we will be paying that. If we are not continuing with that old bond, that means we are saving the payments. That will become the inflow to you. Okay, because you are not continuing. Since you are continuing the new bond now, you have started the new bond, you will have to pay interest on that. At 12%, the interest will be 36 lakhs. Obviously, it is an expense. That's why we will save some tax on that. The net cost of interest after tax will be 2160. Again, there is a flotation cost in the new bond. That is 4 lakh divided by 25,000 will give you every year's expense. But that expense is already paid, so that is not a cash outflow. 40% of that will be considered on annual flotation cost. Why 40%? That will save some tax. So this is a tax saving. This is a cash outflow. Net outflow will be 21,53,600. Now understand, You have saved yourself from paying 2503,200 and you are only paying 2153,600. So what should I call the difference between these two? Annual cash flow savings. Since I shifted from old bond to new bond, I don't have to pay 25 lakhs. I will just be paying 25.53 lakhs. So I am saving 3.496 lakhs every year. And this is going to continue for 25 years. So what I'm going to do next is, for the 25 years, I'm going to take an annuity factor which comes to 10.675. Every year this much of the saving, 10.675. The total saving for the next 25 years. The present value of total saving for the next 25 years is 37 lakh. This is an inflow, this is an outflow today, and the net present value is this much. One more part should have been covered here, which is called as terminal cash flow. But terminal cash flow in both the bonds are like this. If you continue with the old bond, you will pay 300. If you continue with the new bond, if you go with the new bond, you will pay 300. So the net cash flow is 0. That's why the third part is not taken over here. This is called as bond refunding. When you refund the bond, you take the cash flows from the old and new bond and divide the entire period into 3 different parts: initial, operational, and terminal. And then find out the present value of all the cash flows, and then you decide whether the NPV is positive, go with refunding. If it is negative, don't go with the refunding. I am going to summarize the concept here. Summary. In case in future you want to refer. First, write down all the given figures in table format with 2 columns. We can say 3 columns. One for particulars, second old bond, third new bond. Divide the time in 3 parts. First, initial cash flow, annual cash flow, or we can say operational cash flow, which will be annual cash flow into present value annuity factor, and third, present value of terminal cash flow. Find out incremental cash flows for all the above period in all the above periods for both old and new bond. Total will give us net present value of refunding option. If NPV is positive, go with refunding. If NPV is negative, don't go with refunding. And when I talk about refunding, it means old bonds, refunding of old bonds. So in this I can summarize everything. Everything means everything. First of all, write down all the given information in these 3 format, table format, so everything will be clear to you. Then you have to find out 3 different cash flows: initial cash flow, operational cash flow, and present value of terminal cash flows. What you have to do is you have to do the cash flows, find out the incremental cash flows, not for the old bond, not for the new bond, but for the both bonds. And then you will have to do the total of all that, which will give you NPV. NPV we positive, go with the refunding, otherwise go with not refunding the bond. Question number 105, 103 and 104 are same based on the same concept. So that's why I'm keeping it for you, because it is going to take a lot of time, so it doesn't matter. It makes no sense to spend the time on the same thing again and again. Practice makes man perfect. So please try to solve the questions by yourself. Question number 107 is going to be the next question after this break. So welcome back everyone. Welcome back again. And now we are on this 107th question. Dirty price and clean price of the bond. Before discussing the question, I think it's better to discuss the concept. Okay, let's have a look. And it's very easy concept. First of all, let's write down the formula of dirty price and clean price. Dirty price of a bond is equal to, or we can just write down like this, price of a bond is equal to clean price plus accrued interest. This is how it is. Now, let me explain this entire thing to you. Let's say, for example, there is a bond with a face value in the market of 1000 rupees, coupon rate of 10%, time of 5 years, and market price is yet to be known. Okay. Now, let's draw the timeline. Okay, this is first year. The moment you will complete first year, suppose you have purchased this bond, and the moment you will complete the first year, you will get 100 rupees. Do you agree? As an interest. Now, this is where the second year will end. Third year, fourth year, and let's say fifth year. Okay. Now, let's say, for example, you are standing at this point and you don't want to continue with this bond. You don't want to continue with this bond. What is the option with you? To sell this bond in the market to someone else, because the redemption will happen only after 5 years. So the only way right now to get your money back is to sell the bond in the market to someone else. And when you will go to sell the bond, the bond's market price will play the important role. So we can say, just excuse me for some mistakes, the grammatical mistake that I'm doing in English sometimes, because I just realized that I told that I said that word, the important, and I was like, what is the important? Okay. So that's a mistake and I'm learning on that. I hope that won't be a big problem for you. Okay. So market price, let's say, for example, the market price at which you will be selling the bond. So suppose you are selling the bond in the middle of the second year, and the market price at that point is 1070. Okay. And you are selling the bond on that date. I have purchased the bond on that date. So I paid 1070 to you, and the bond owner is now Mayank Kothari. The moment he will complete 2 years, the company will pay second year interest, and the entire interest of 100 rupees will be paid to Mayank Kothari. To me, not you, to me. Because on the record date, I was the bond holder on that date. Okay, agree. Now, don't you think it's unfair to the person who has held the bond for half year and he's not getting any interest? And I have held the bond only for the second half of the second year, and I have got full interest of 100 rupees. Practically speaking, I should have received 50 rupees only, and you should have received 50 rupees also. But that is not the job of the company who has issued the bond, to write down everything when someone is selling the bond and to whom we should pay this much of the interest, and rest of the interest should be paid to Mayank, Kothari, and so on. No. That's why, in order to simplify things, what happens is there is a record date on which all the bondholders will be eligible for the next interest. Do you understand this? Okay. Now, you might be thinking that something unfair has happened here, because you were eligible for the half year's interest, which was 50 rupees. And you might be thinking that when you sold this bond to me at 1070, you didn't receive 50 rupees of the accrued interest. Is it right? No, sir, it's wrong. You had already received that 50 rupees, and it is deemed that those 50 rupees was included in this 1070. It is deemed that the 50 rupees that was accrued is included in this 1070 market price. Now, what happens is that when you start your journey from this date, okay, with every passing day, the interest for that day gets accrued. Accrued means you get the right to receive the interest for that for those days. Okay. But the main problem is company has set the days when the interest will be due and paid. The interest will be due at the end of the year only, and it will be paid by the company at the end of the year. So what happens is that the accrued interest for this period gets included in the market price over a period of time. The moment you will reach here, the market price will become higher, will be a little higher, because the more interest has been accrued in that. And the moment you will reach here, the market price will drop by that much of the amount, theoretically 100 rupees, we can say. So let's say, for example, the market price has reached to 1120 on that date. Just imagine. Okay, 1120 on that date. Now what will happen? 100 rupees of the interest will be paid. We are assuming that just before the day of interest payment, the market price of the bond is 1120, and we are assuming that 100 rupees is included in this, right? Included in this. And the moment interest day, or it will be due, the moment interest will be paid, theoretically the price will fall by that much of the amount, and it will come down to its real price, which will be 1020. That 20 rupees extra is because of the extra demand in the market for that bond. Okay. Now, all in all, I can conclude one thing. This amount of 1070 or 1120 is called as dirty price. And this dirty price includes two things: clean price of the bond plus accrued interest. In this question, we can say 1070 is the dirty price, out of which 50 rupees was the accrued interest and 1020 was the clean price. What do you mean by clean price? The word itself specifies or explains everything, that a price of the bond without any other attachment of the interest, without attaching any kind of a interest or any liability or assets, the price of the bond, that is 1020. Do you understand this? Okay. So at any point of a time in this entire scenario, any price, market price of the bond will be called as the dirty price. Now understand one thing. On, let's say, for example, 30th June, this is 1st of the July, 1st of the January. So on 31st December, the price was 1120. At that time, we will say that the dirty price is 1120 and 1020 is the clean price and 100 rupees is the accrued interest. The very next day, 100 rupees of the interest payment will be given to the bondholders, and the market price of the bond will fall to 1020. Now the dirty price will be 1020. Out of that, the entire amount is clean price and the accrued interest is 0. Don't you think so? The accrued interest is 0 because today is the very first day of interest. The one day has not even completed. So even one day of interest has not accrued in that amount. So that's why it's 0. On that day, please understand, ladies and gentlemen, on that day, clean price will be equal to dirty price. The day when the interest will be paid off. Just before that day, just understand, this is, let's say, 1st of January and this is, let's say, 31st of December. You can clearly see just before that day 100 rupees was included in that price, 1020, and just after that it was nothing, zero, because it started from zero again. This 1020 is the market price. It may go up or down due to market demand. It can be 1040 also on the next day. That extra 20 rupees from 1020 to 1040 will be credited to the higher demand of the bond, not the accrued interest, but higher demand of the bond. Okay, so that was the entire concept that we discussed. Now let's solve the question. Now this is a very good question with in front of you. MP Limited issued a new series of bonds on January 1, 2010. The bonds were sold at par. At par means the market price was also 1000 at that time. Having a coupon rate of 10% per annum and matures on 31st December 2025. Please understand and pay a close attention to when the bond was issued and when it is being matured. It was issued in January 2010. So entire 2010 is still remaining, pending, we can say. And it is maturing on 31st December, not January 2025. So entire 2010, and after that 15 more years. So 1 plus 15, it goes to 16 years. This is where lots of students has made the mistake. Please understand, this is the question from the institute's material when I was the student of CA final. So I have seen lots of students making mistake in the last 10 years in that. Okay, I started teaching in 2014, so we can say 8 years only. Okay, let's move ahead. So the total period is 16 years. Coupon payments are made semi-annually. Underline this thing. This is going to make our calculation little complex, because now if 16 years are there, there will be 32 coupon payments of half years each. The coupon rate of 10% will become 5% for every half year. Again, it will be paid on June 30th and 31st December. 31st no. Assume that you purchased an outstanding MP Limited bond. Now you come into the picture and you have purchased the bond on 1st March 2018. After 2010 you are purchasing the bond on 2018, and that too not on 1st July, not on 1st January, in the middle of the first 6 months, that is 1st March 2018, just 2 months after the last interest payment, January, February. When the going interest rate was 12%, this will be YTM, and for half year it will be 6%. Please remember, when the word semi-annual is added in the entire question, coupon rate will be half, YTM will be half, number of period will be double the years, 16 into 232. What was the YTM of market price MP Limited bonds as on January 1, 2010? So it is talking about this date. When you issued the bond at par, at that time market price was equal to face value, right? If the market price is equal to face value on that date, coupon rate will be equal to YTM. So YTM will be 10%. A very simple answer. YTM will be 10%. It is sold at par. Understand the fact? Very easy question. The main thing is the second part. What amount you should pay to complete the transaction? Of that amount, how much should be accrued interest and how much would represent bond's basic value? Please understand, my friends. Underline this basic value and write down clean price. They want to know the clean price and accrued interest. And the amount that you will pay will be called as dirty price. You will always pay dirty price. Okay. Let's be professional. So from the entire transaction, I'm just writing the required number of required dates. This is 1st January 2018. January has ended at this date, February has ended at this date, and the March has started. So what I will write is 1st February 2018, 1st March 2018. Okay. April, May and June. This will be 1st July 2018 after the June. Okay. This is only 6 months that I am considering. First of all, you are purchasing the bond on this date, and they are asking you to calculate the market price that you will be ready to pay at any point of time. If you are buying the bond, the market price of the bond should be present value of future cash flows. That's what we have been learning. Present value of future cash flows at any point of time. Now it's very difficult for you to calculate the present value of future cash flows from this point, because you have to take March, April, May. Okay, one more month has to be considered. So it will be 1st April, May, June and 1st July 18 year. Okay, so there are 4 months in this half year, and after that the number of years can be counted. So it is very difficult to find out the price from this point. What is the formula? Let's say market price of the bond is equal to interest for half years into present value annuity factor, which you will calculate at 6%. But for how many number of periods? Redemption value into present value factor at 6% for how many periods? You can't calculate half years from this point. Please understand. Either you can calculate the half years from this point or half year from this point. You can take any of the number and we can find out the answer. Let's take this one, 1st July. So let's say, for example, we are calculating the market price at this date. Okay, market price as on 1st July 2018. Now calculate the number of half years left till maturity. Half year of July 2018 is still pending, still remaining from July to December, and after that 2019, 20, 21. Okay, 22, 23, 24, 25. 7 years. 7 into 2, 14 half years and 1 half year of this 2018. In total, there are 15 periods which are remaining, 15 half years remaining till after 1st July 2018. 15 half years. Okay. So what I am going to do is, we will just take 15 here and 15 here. With the help of this, interest is 50 rupees only for half year, 5% of 1000 into, let's calculate the annuity factor and present value factor as well. 1 divided 1.06. 0.417 MRC 9.712. 485.6 plus 417 902.60. This is the market price of the bond as of 1st July 2018. Okay, let's fix that. So we have reached till that point. 902.60 is nothing but the present value of future cash flows. Okay, and do you understand, the interest is paid on every half year, after every half year. So the first interest would have been paid on 1st January 2018. First means the interest would have been paid, the last interest would have been paid on this date, and the new interest would have been paid on this date. So basically speaking, today the company has paid the interest past interests are never included in the market price. The moment you will go one day, you will go back just for one day, the entire 50 rupees will be included in this 902. I will show you. Let's say this is the price on 1st July 1020. If you will go just one day back from 1st January to 31st December, you will understand the entire interest amount was added in this price. So it became 1120. The difference of one day, and you can see there is a difference of 100 rupees of the interest. In the same way, if we go back for one day on 30th June and find out the market price, it will be 902.60 plus the accrued interest. Do you agree with that? 902.60 plus the accrued interest. And accrued interest for 6 months, accrued and the due interest. So that was for 6 months, that is 50. So can I say like this, market price on 30th June 2018, a day before will be 902.60 plus 50 rupees, that is 952.60. That's it. Okay, do you agree with this thing? The same thing we discussed here. Now what we have to do is, the only calculation is that the calculation that we have to do is, we have to bring this market price till this point, discount that market price by 4 months, not entirely by 6 months, 4 months, and you will see, you will have the market price that you wanted. So therefore, market price as on 1st March 2018, understand, entire March, April, May and June, there are 4 months of difference between these two dates, and it's very simple. 952.60 into 1 divided by how much? 6% for 6 months, 4% for 4 months. Understand? 6% is the YTM for 6 months, 4% for 4 months, 1.04. How did we calculate that? Simple. Your market price will be 915.96 rupees, and this is your first answer. The amount that you should be paying on that date, the amount that you should be paying on that date is 915.96. Okay, this is called as the dirty price, first of all. Second, this is the answer for first. Let's write down 915.96, right? 915.96. Now this 915.96 can be easily compared with this 1070, and I told you that 1070 includes the accrued interest for the first 6 months. So I can clearly say that 915.96 also includes the accrued interest for the first 2 months, because the last interest paid was on this date, and from that date all the interest is getting accrued in this. So 915.96 becomes the dirty price. Okay, dirty price has been calculated. Let's calculate accrued interest. Accrued interest 1000 into 5% for 6 months, then 2 by 6 multiplied by 2 by 6 for 2 months. How much is the accrued interest? So 50 into 2 by 6, 16.67 rupees is the accrued interest. So the final answer, bonds basic value, or you can say clean price of the bond, is nothing but dirty price minus accrued interest. Are you satisfied with the formula? Dirty price was equal to clean price plus accrued interest. Then can I say clean price is equal to dirty price minus accrued interest? Yeah, obviously. 915.96 minus 16.67. 899.29. So this is your second answer. This was your first answer. Which one? This one. Happy with the answer and the concept? Have a look on this. Bond were sold at par. Price of the bond, they calculated 902, then they calculated 952, then they calculated 916, or you can say 915.96. This is the way we calculated, the alternative way that they said. Okay. And then the accrued interest 16.6 and 67. So the bond's basic value is, alternatively, if we minus this amount, we will get the bond's basic value out of this amount. Don't go with this, just a suggestion, go with this. So if you go with this, you will deduct 16.67 from 915.96 and you will get the basic value, which has not been given in here. Okay, that's the completion of the question number 107. Question number 108, 9 and 10 are that will cover some new concepts, and we will just look at the question, and according to the question we will go with the flow, because there is no particular question or concept which is covered from this from these question in the syllabus. So these are randomly asked question which includes the concepts from CA Inter as well. So we learn about it while solving the question itself. Have a look on this question. Capital structure of Sun Limited as at 31st March 2003 was as under. There is a company and the capital structure of that company is like this. They have raised equity share capital worth 80 lakhs, 8% preference share capital worth 40 lakhs, 12% debentures worth 64 lakhs, and the reserves are 32. Please understand, this and this constitutes equity capital, 80 plus 32. Okay, the total capital is 216 and the equity capital is 112. Okay, good. It will be of some benefit after that, after reading the entire question. Sun Limited earns a profit of 32 lakhs annually on an average before deduction of income tax, which works out to be 35%, and interest. Interest is also not deducted from that income. So this can be called as earning before interest and tax, because interest is also not deducted, tax has also not been deducted. Sun Limited has been regularly paying equity dividend of 8%. Calculate. On 80, 8% will be 6.4 lakhs. Am I right? Normal return on equity share of companies similarly placed is 9.6%. Okay, so basically, if we find out a similar company in the market and invest in the equity share of those companies, the return that those companies will provide is 9.6%. Okay, but there are certain conditions. If that is fulfilled in this question, in this company also, then this company will also be to be said that it will also provide that 9.6% of the return. But if we find that this company is riskier than the other companies, if this company is riskier than the other companies, then the return will be lower. If it is not that riskier, return will be little higher. Have a look. Profit after tax provided, there are three conditions. Provided after tax covers, profit after tax covers fixed interest and fixed dividend at least 3 times. So what is the formula for interest coverage ratio? This is called as fixed interest coverage ratio. This is saying that the profit after tax that you will calculate, let's calculate the profit after tax. PBIT 32 lakhs, you will just deduct the debenture. What is the debenture? 12% on 64 lakh. You will calculate, that is 7.68. The profit before tax will be arrived. You will deduct the tax, and this is the profit after tax. The question is saying that this much of the profit after tax that your company has should cover the fixed interest and preference dividend, the fixed dividend, at least 3 times. That means if you total the fixed interest and fixed dividend, it should be, let's say this is X, then 15.808 lakhs should be 3 times X. So 3x should be equal to 15.808. So we will have to first add these two things. Okay. Preference, let's write down preference dividend 40 into 8%, that comes to 3.2 lakhs, and 12 into 64, that comes to 7.68 lakhs. Can I say that this is the fixed dividend? Yes. On the equity dividend is never fixed, but you will have to pay the preference dividend anyhow. So that dividend is called as fixed dividend. And 12% debenture interest is also fixed. All they are asking is about the fixed payment only, and the total payment is 7.68 plus 3.2. That means you have 10.88 lakhs of fixed payment every year, and your profit after tax should be 3 times of this, right? Let's calculate. Interest coverage ratio is equal to profit after tax divided by fixed interest plus fixed dividend. Simple. It was 15.80. See, how much is our coverage ratio? It's very simple. 15.8088 lakhs, and we are going to add back the debenture interest. This is tricky part that you should understand. Why? Because see, 15.80800 lakhs is the profit after tax after paying the interest. If you have already paid the debenture interest, then debenture holders do not hold any right on this. And if you want to find out how much this profit covers the interest, then you should find out the profit before paying this amount. If you have already paid this amount, then you cannot ask this profit to cover the interest again. So that's why any figure that is being divided, or that we want to be covered from this profit, should be added back if it has been deducted. The question is very simple. This is you have earned 10 rupees, you have given me 2 rupees, okay, the balance is 8 rupees, okay. Now this is me, I have received 2 rupees. Now I am asking, how much is your earning, or how much your earning can cover my profit or my payment? My payment is 2 lakh rupees. And how much did you earn? How many times you can cover my payment? And for that purpose, you will take 10 lakhs, not 8 lakhs. From 8 lakhs, I cannot demand anything because you have already paid to me. So I will have to add back 2 lakhs to it to make it 10 lakhs. And then you can say that 10 by 2 means 5 times you can cover the payment which is payable to me. So anytime if I'm asking how many times you can pay my amount, you will calculate or put the amount from which the interest is yet to be paid. Why we took 15,800 plus 768 and not 32 lakhs? Because we had to pay some tax to the government. So we took the after tax profit and added back the interest, just to know that the government amount has been paid to the government. The whatever was due to the government was paid to the government, and this is the amount in the numerator which is eligible to be paid for the interest and dividend. Okay, so 23,48,800 is the total amount available with you from which you can pay the dividend, and that too only fixed dividend. Question is asking, you might ask me that why equity is not added? Because equity dividend is not fixed. It can be paid in on some years, it cannot be. Okay, so 2.16 is the answer, and which is bad. It is bad. Other companies, understand, other companies can pay 3 times this amount, and you are not even able to pay it 2.16 or more than 2.16 times. So this is a bad news. Interest coverage ratio higher the better. And in this case, our interest coverage ratio is lower. Lower by how much? 0.84. 3 minus 2.6 times. 0.84 times your interest coverage ratio is lower. Okay. Then second condition. The second condition is, and for what purpose this condition has been placed? If the other company's return has to be taken as 9.6%, then this condition should be satisfied. Capital gearing ratio of 0.75. First of all, you need to understand what is 0.75 and what is capital gearing ratio is. Capital gearing ratio says that in your company, how much of the outsiders money has been raised as compared to the owner's money. If I, being the owner of the company, has contributed 1 rupee and I have raised 0.75 rupees of the debt, 70 paisa of the debt in the company, then my capital gearing ratio will be 0.75. It means that 0.75 of outsiders money for 1 rupee of owner's money. Understood? Now, this is the capital structure in front of you. You tell me who are the outsiders and who are the owner. Very simple. Then we will decide. Can I say equity shareholders are the owners? Okay. O, outsider and owner both has O in the beginning. So, owner, preference shareholders outsider, debentures outsider, and reserves also belong to the owner. So what you have to do is 40 plus 64 will be the outsiders fund in the company, and 80 divided by 32 will be the owner's fund. You will find out our capital gearing ratio, and if we go with this, we find that 40 plus 64 preference plus debenture 104, 1 crore 4 10 lakh 40,000 or 1 crore 4 lakh rupees. 1 crore 4 lakh rupees is of the outsiders money as compared to 1 crore 12 lakh rupees of the owner's money. That means the ratio is coming to 0.93 of outsiders money for 1 rupee of owner's money. Now you tell me, capital gearing ratio itself means how much of the outsiders money is there in the company as compared to the owner's money. And this is the ratio in front of you. You tell me, higher capital gearing ratio is good or bad for the company? It's bad for the company. The higher the capital gearing ratio, the bad will be for the company. Bad news will be for the company, because outsiders are getting more control of the company because you are increasing the outsiders money in the company. So the more you raise debt, the more you will be in trouble. Outsiders money higher will be bad news. So again, fixed interest coverage ratio should have been higher. It would have been better, but it is lower than the industry average. 3 was the industry average. Ours is lower than that. This is bad news. 0.75 was the industry average. Let me just do some charging of the pencil. Okay. 0.75 was the industry average in the capital gearing ratio. Ours is 0.93, which is very bad. Others are only raising 75 paisa of outsiders money as compared to their contribution, and we are raising 93 paisa as compared to our contribution, which is bad. Why we are raising more of the outsiders money in the company? That is bad news. Again a bad news. That was also a bad news. Okay. The third thing now. And how much is the difference? Please write down. Industry average was 0.75, right? So 0.18 is the difference. Here the 0.18 times is the difference and 0.84 times is the difference here. Okay. Then, okay, now the third part. Yield on share is calculated as, now we are calculating the return on this share. We are calculating the return on share. Please understand, share means the equity shares. Okay. And they are proposing some conditions. 50% of the profit which has been distributed. So what is the net profit to us? See, profit after tax was 15,80,800. After that we paid the preference dividend, which was 3,20,000. Okay. After that we paid the equity dividend. This is the profit that we have distributed to the equity share. We are calculating the yield on share. So on equity share itself, not preference share, equity share income will matter to us. If we want to calculate yield for equity, take the return of the equity on the numerator. So they are saying that the return is nothing but 50% of the profit which has been distributed to the shareholders. So 50% of this 6,40,000 profit has been distributed to the shareholders, and 6,20,800 is undistributed profit. Also pertains to the shareholder only. Do you agree with this? This is of the equity and this is also of the equity. This is distributed, this is undistributed. So take 50% of 6,40,000 and 5% of 6,20,800. That is the condition that they have given. There is no logic for that. Why? There is no logic. If they have said, we will consider that thing. Okay, have a look on this. 50% of 6,40,000 the dividend and 5% of 6,20,800. If you do the total, this will become the yield, means the return. So you will keep that in the denominator. How do you calculate the yield? Yield is nothing but the return divided by investment, and in return has become 350,1040, and in the denominator you will keep equity share capital. The bad thing that I felt here is they have only kept 80 lakh as the equity share capital and not 32 lakhs of the reserve. This is also the investment of the shareholder over a period of time. So if you calculate the equity's worth, it will be 80 plus 32, and it should not be only paid up capital of 80 lakhs, which is, I feel wrong, but still we cannot help it. This is the old question in the institute's material, and they have been taking it like that only. My suggestion 80 plus 32, but in exam do it 80. Keep that for the practical knowledge, na? Do it in the exam like this. So what they did is they said that this much of the yield should be there on the company, that is 4.39%. But the story is not yet over. 4.39% should have been the yield of the share, but there is a problem. The problem is that see what exactly they are saying. Analyze the value per equity share. We don't have to find out the yield, we have to find out the value of the share. And they are saying that the yield on this share is 4.39%. Okay, now come over to this part. Let's write down 4.39%, and we have to calculate the value per equity share of the company assuming the risk-free premium. It means if the company is risky, we will have to add more percentage to it. Higher the risk, higher should be the return. If I'm investing in a riskier company, then I will expect more return from that company. Because my money is going into a riskier investment, I will be expecting more return. See, there is a company who is less risky, there is a company who is more risky. Can I expect the same return from both? No. If the company is more risky, then I will expect more return from this. So why our company is more risky, I will tell you. Our company's interest and fixed dividend coverage ratio is bad. So this adds to the riskiness. Then capital gearing ratio is also bad as compared to the industry average. This also adds to the riskiness. Now they are saying that what you can take is 1% for every one time of difference for interest and fixed dividend coverage ratio. You add 1% of the required yield, means you demand 1% from the company if the industry average of 3 times and the company's interest fixed dividend coverage ratio has a gap of 1 time. But our fixed interest coverage ratio was 2.16, industries was 3, so the gap was only 0.84 and not entirely 1 time. And question is saying that if there is a gap of 1 time, you demand 1 more percent. That means if there is a gap of only 0.84 times, we will demand only 0.84 times a percentage. 1% for 1 time, 0.84% for 0.84 times. Do you agree? Second thing, they are saying that if the capital gearing ratio is also bad, then demand 2% from the company for every 1 time difference. In our case, it's not even 1 time difference, it's just 0.18 time difference. 0.18 times. So what we are going to do? We are going to take the proportionate demand from that. 2% into 0.18, that is 0.36%. So all in all, what we are going to do, we are going to demand some extra returns from the company because of the risk that we are taking because of the bad fixed dividend coverage, fixed income coverage ratio and bad capital gearing ratio. How much extra we will demand? 0.84 and 0.36 above the industry average, which was this. 9.6% is when you are following this. If you are not following this, your industry average is bad, then addition will be there. So 9.6 plus 0.84 plus 0.36 will be a good required rate of return from the company. Now you tell me one thing. I will just summarize it. There are two companies, A and B. This industry average is 9.6%. Okay. And this is our company. Can you invest in the company if this company is also paying 9.6%? You won't invest because you can clearly see the fixed interest coverage ratio is bad for this company. Capital gaining ratio is also bad for this company. So what you are doing is, if it is bad, if you are taking more risk, you are adding more return in your requirement. So we are adding 0.84 and 0.36 and it is becoming 10.8%. Now with a lesser risk, you can get 9.6% if you want to invest in A. With a little higher risk, if you invest in B, you can get 10.80%. And that's we can call it as a fair one. This can be, this is higher return because it contains higher risk. So 10.80 is the standard that we should expect. But now the story will be like this. See. 0.84 times 0.36 times it goes to 10.80. Now entire story will end up here, and that is more theoretical. First of all, they have assumed the paid up value as 100 rupees. Never in this question, nowhere in this question it is given to us, so that's a subjective matter. Also, what they are saying is that 100 rupees should be the market price of the company if 10.80% is the return. But the yield of this company is only 4.39%. That's why the market price should be 40.65. 4.39 divided by 10.8 and 100. Practically speaking, I am also not satisfied with this type of calculation. This is no logic. First of all, why we are calculating the value of the equity share by comparing with the paid up value? Paid up value and the value of equity share has no relevance, first of all. But still, if they want to do it, just do it like this. This is just a subjective in nature and there are some problem or ambiguities in the question. But you cannot help it. In order to gain the marks, you have to do it like this if it comes in exam. But keep it for the practical knowledge. What we have to do is to score the marks at the end of the day. And in real life, we will apply what is right. That was question number 108, and 109 is going to be this one. Have a look. This is also an interesting question. So have a look on this. HLL has 8 crore of 10% mortgage bonds outstanding under an indenture. Indenture will have some conditions. 10% mortgage bonds, 8 crore worth. The indenture allows additional bonds to be, indenture is nothing but an agreement, okay? Allows additional bonds to be issued as long as all of the following conditions are met. Okay. It says that indenture, that agreement says that you already have 8 crore rupees of the bonds in your company. You can issue additional bonds only when these conditions are satisfied, all of them. Pre-tax interest coverage ratio. Understand, pre-tax interest coverage ratio. The last time we calculated the interest coverage ratio, it was after tax interest coverage ratio. Now this time you will be taking income before tax plus bonds interest, or you can simply take EBIT. The meaning of it is income before tax plus bonds interest divided by bonds interest. There is no preference share in this. Remains greater than 4. If we calculate the coverage, tax coverage ratio, it should remain greater than 4 after the issue of those bonds. Please understand, they're not talking about the current situation. They are saying that 8 crore plus whatever you issue. After that, the interest coverage ratio should be more than 4. Net depreciated value of mortgage assets. We'll talk about it. The depreciation thing is given here. remains twice the amount of mortgage debt. Whatever the debt is there in your company, your asset, mortgage depreciated asset means the basic value less depreciation, the cost minus depreciation. Okay, it should be twice the amount of debt that you are having in the total. So let's say 8 crore plus 4 crore, 12 crore is the total debt. 12 into 2, 24 crore of the mortgage assets should be there. That's just an example. Debt to equity ratio remains below 0.5. That means you should not raise more than 50 paisa of the outsider's money for 1 rupee of the owner's money. Debt to equity ratio. So all the condition has to be satisfied. Now see, the HLL has net income after taxes of 2 crore and 40% is the tax rate. You have to do the reverse calculation. Are you getting it? Start from profit after tax, add back tax, then you will get profit before tax, add back interest, then you will get profit before interest and tax. 40 crore rupees in equity and 30 crore rupees in depreciated assets covered by the mortgage. Assuming that 50% of the proceeds of the new issue, please understand, whatever you are going to issue, the new bonds, of that 50% would be added to the base of the mortgaged assets. Whatever you will issue, let's say you are issuing 5 crore, so 50% of that will be 2.5 crore. The net depreciated asset will then be 30 plus 2.5. Okay, and that the company has no sinking fund payments until next year. No extra payments has to be is there in the company. How much more 10% debt could be sold under each of the three condition? Which protective covenant? Covenant means which of the three conditions is binding. It means that in which conditions is covered in all of them. So first of all, what we are going to find out is, we are going to find out how much of the debt we can raise under each of the condition. Let's say it says that maximum 7 crore you can raise, it says that maximum 5 crore you can raise, and it says that maximum 12 crore you can raise, maximum. So if we look at all the three conditions, we can only raise 5 crore rupees because 5 is included in this one also and this one also. If we raise 5 crore, no condition will be dissatisfied, or no condition will be, we can say that all the conditions will be met. If we raise only 5 crore, if we raise 7 crore, this condition will not be met because it says no more than 5 crore you can issue. If we raise 12 crore, these two conditions will be defeated. Then the answer will be this, and the protective covenant that will be binding on all of the others is this one. So that's what we have to calculate. Take one by one and find out. Okay. 2 crore is the after tax profit, that means it is 60%. Now 2 divided by 60% is 3.33. Okay, let's follow the method. See, 2 divided by 60% will give you profit before tax plus 8 crore into 10% will give you 8 crore into 10%, or I can just complete this in this manner, or otherwise I can write it down also. The first condition, okay. Interest coverage ratio should be, the formula is profit before tax plus interest divided by interest. Okay. Now understand, this should be 4 after raising the additional funds, and additional funds that you are raising, let's say it is X, you will also have to pay interest on that. Remember that you have to pay 8 crore into 10% on the existing interest on the existing bonds, but you will also have to pay interest on the new bonds. Okay, so profit before tax is nothing but profit after tax divided by 1 minus 0.40, that is 60%. If 40% is the tax rate, 60% will be the profit after tax, plus 8 crore into 10%, am I right? Existing interest on existing bonds plus x into 10%. I will also be paying interest on the additional bonds, right? In the denominator, total interest. That means 8 crore into 10% plus x into 10%. Are you good with this equation? And now you only have to follow the equation and find out x in that. So it's very simple. 4 is equal to profit after tax was 2 crore divided by 0.6 plus 0.8 plus 0.10x divided by 0.10x plus 0.8. Let me solve it. 2 by 0.6 plus 0.8 gives me 4 is equal to 4.133 plus 0.10x divided by 0.10x plus 0.8. Now I'll take the denominator on that side. So it will be 0.4x plus 3.2 is equal to 4.13 plus 0.10x. So let's take x on one side and the other figures on another side. It will be 0.30x is equal to 0.93 and x is equal to 3.1 crore. It means that if you want to satisfy the first condition, you cannot raise more than 3.1 crore. That's it. It was as easy as it is. 3.1 crore. Now you will remember everything given in this. Okay. Second condition. Net depreciated value of mortgage assets remains twice the amount of mortgage debt. Have a look. We can solve it here as well. Can I write down like this in it? That existing debt, mortgage assets. Let's write down the formula. Mortgage assets should be equal to 2 times the debt. The debt is 8 plus x, the additional debt that we are going to raise. As simple as it is. 30 crores. Mortgage assets. Okay. How much is the mortgage assets? Sir, it will be 30 crore plus, understand, 50% of x. They said that whatever bond you are going to issue, 50% of that will be added to mortgage debts. And 16 plus 2x. Solve this equation. 14 is equal to 1.5x and x is equal to 9.33 crores. Do you understand? 14, 1.5, 14. This is the condition. And the third one, debt to equity ratio. Debt to equity. Debt is 8 plus x. Can I say that? 8 plus x and the equity is 40 crore. And it should be 0.5, not more than that. Just solve it and you will get the x. 8 plus x crore, that will be the total bond after the raising, divided by 40 should be equal to 0.50. Debt to equity ratio. You only have to remember the formulas in this part. Otherwise, the rest of the question is very easy. Now there are 3 answers. According to the first condition, you can only raise 3.10 crore. According to the second condition, you can only raise 9.33 crore. According to the third condition, you can raise 12 crore. Now which protective covenant is binding? The first one. Because if you go with the first one, all the conditions will be satisfied, otherwise not. Since all the conditions are to be met, then 3.10 crore is the maximum that you can raise. The binding conditions are met and it limits the amount of new debt to 3.10 crore. They have not written over here. As per condition 1, this is becoming the protective covenant. The first condition is binding on all of them, all the others. Now come to question number 110. This is going to be the last question before we start with the money market. And this is also related to interest coverage ratio. Have a look. Tiger Limited is presently working. Very easy question. Tiger Limited is presently working with an EBIT of 90 lakhs, earning before paying any kind of interest and taxes. Its present borrowings are as follows. Have a look. Presently, it is paying 12% on the term loan of 300 lakhs. That will contribute to an interest of 36 lakhs. Am I right? 15% on 200 lakhs. that will contribute to 30 lakhs in interest, and 11% on this 11 lakh. The total interest that you are paying right now is 77 lakhs. Out of that, 36 lakh is the long term and 41 lakh is the short term. Okay. Now, what is happening? If you go with the current interest coverage ratio, there is no tax rate given in this question. So if you want to calculate interest coverage ratio, it will be simply EBIT divided by the interest amount, which is 90 divided by 77. The current interest coverage ratio is 1.169. That means you can cover only this much of the time your entire cost of fixed interest. That's all okay. But now the company is saying that our sales of the company are growing. And in order to support that, we need to purchase the raw material and we need to obtain additional borrowing for that worth 100 lakhs. Now they are adding 100 lakhs at an expected cost of 16%. That means an additional 16 lakh rupees of the interest. 77 plus 16 means after this borrowing, your total interest cost will be 98 lakh rupees. Okay. The increase in EBIT, because of the increase in sales, the EBIT will also increase by 15%. So if you will increase the EBIT by 15%, it will be like this. 90 is the current EBIT, 15% comes to 13.5 and the total will be 103.5. And there is something bad which is happening here. Please understand. Can you clearly see that we are only increasing the income by 13.5 lakhs, but for that purpose we borrowed this much of the amount, which increased our interest by 16 lakhs. So it is adversely affecting our income. We are earning 13.5 lakhs and for that 13.5 lakhs of earning we are spending 16 lakh rupees. Okay. Calculate the change in interest coverage ratio. Change means what was the interest coverage ratio earlier? 1.169. What is the interest coverage ratio now? After the additional borrowing is effected and comment on the arrangement made. So what is the current EBIT is this and interest is this. Please see, there is no preference dividend, no taxation, nothing is there. Very simple answer. 103.5 divided by 90. 8. So the new one 98 or right now 90 plus 15% divided by 98. So it is coming down to 1.056. 1.056. See, this was the previous interest coverage ratio. This is the new interest coverage ratio. You can clearly see the interest coverage ratio has gone down. Okay, my mistake. 77 plus 16 lakhs. My mistake is that much. The total is not 98, it is 93. So if you do the calculation again, it comes to 1.113. Now you can clearly see the interest coverage ratio has gone down. Why? It is very simple. In order to earn 13.5 lakh, who will spend 16 lakh rupees in the interest? So this is not in your favor, whatever you have done. And that's why the interest coverage ratio has gone down. That's it. It was 1.169 earlier, now 1.113. Simple and easy question. The answer: with the proposed increase in the sales, the burden of interest, which was 16 lakhs on additional borrowing, will adversely affect the interest coverage ratio, which has been reduced. Simple. That's what is there, adversely affecting the profits. 13.5 lakhs of additional income at the cost of 16 lakhs is not a good decision. From the next question, we are going to discuss about the money market thing. These are very easy and small questions. So we will cover up rest of the part of this chapter in the next or maybe maximum the 2 lectures. Bye bye for now.